All right, 12:01. I'll get started. I appreciate all who have joined, and hopefully you'll get something out of this as we move into the hot spring selling market. So this is about the smart strategies for buyer agents. I'm Brian Allen, mortgage advisor for Collab Lending, and welcome. And let's get started. So what's ahead here? I'm going to talk about the big thing that just was announced within the last month, the Fannie and Freddie loan level price adjustments. And of course, we're going to talk about some strategies for buyers heading into the spring summer season. And then lastly, with those strategies, you'll see that the appraisal will be very important. And it's a question that I get a lot from realtors when I explain these strategies is what if the house doesn't appraise? So the Fannie and Freddie loan level adjustments, this happened back in 2020 as we were going into the pandemic. There was a lot of uncertainty. Rates were really low and they were going lower. And Fannie and Freddie put these loan level price adjustments in that essentially weren't really popular for people who do what I do. And if there's any big change coming, it's usually something to do with a money grab, to be honest. And this is no different. And hopefully we have the same results. In 2020, we still had fantastic interest rates, even though they built in some pricing adjustments, which I'll show you here in a second. And I think once we get through the summer, those rates are going to continue to come down again. So we're going to have some short-term pain for a while. And what does it look like? I'm going to just show you specifically with credit score because that's the one that really jumps out at me. Last week, if you had a 740 credit score, that meant you had the best interest rates possible. Anything over that was gravy. Now, these loan level price adjustments are going to take effect May 1st. And they're also, many of the lenders are already starting to roll them in. So actually what I'm telling my clients is that are shopping right now, you're going to want to have a sales contract fully executed by March 4th if you want to game the system and take advantage of the more advantageous rate. So when these loan level price adjustments hit, there's going to be 3 more levels or 2 extra levels to what was previously 1. It's really 740 to 759 and then 760 to 779 and then 780 and above. So what that means is what was 740 is now 780. If you're below 780, you're not going to have the most advantageous interest rates. And let me give you a specific example. On a purchase, it's not going to be as brutal for purchases as it is for refinances. And the reason they're doing that is because if the interest rates drop too low, obviously everyone knows the second half of 2022, the interest rates essentially doubled from where they were in in January of 2022. So all those people that had to buy at that time, if the rates drop too much, they're going to refinance. And servicing of the loan is where Fannie and Freddie make the money, where lenders make the money, is servicing the loan. So if a person isn't in the loan long enough, they're going to lose money. So they're trying to disincentivize people from refinancing. But looking at this chart, you see on the purchase side, there's probably going to be an increase of anywhere from an eighth if you had a 740 credit score to maybe 3/8. But on the refinance side, it's almost a point difference in interest rate once these loan level price adjustments hit. So what does that mean? Like I said, there's going to be an increase if you're below 780. If you're above 780, it'll be a muted drop or just may maintain for the short term. Again, probably by 2024, we're going to see those interest rates where refinances might make sense. So it's just going to push us back on the refinance market. If someone's looking for a home, it's still a great time to be buying a home. And if you're currently looking, as I mentioned, you want to have your agreement of sale fully executed because you cannot lock without a fully executed agreement of sale. So March 4th is that date, and that's what I'm telling my clients who are currently looking. If they can try to find a place by then, it'll be better for them. And then after March 4th, let's say you're looking to purchase in the summer, late spring or summer, there's time for you to work on your credit score and get it to that 780. And as a broker, we have so many tools that sometimes the big banks don't have. One would be the score wizard, where I can plug in and say, hey, what does this borrower have to do to get to a 780 credit score? And it'll spit it out what that borrower has to do. And if it's a really motivated buyer and they really want to make it happen in 5 to 7 business days, we can also do what's called a rapid rescore. That costs a little money, and that varies from borrower to borrower. Like if you don't have to pay, there's usually things that I can tell you that cost you nothing, like the score wizard, that can help you with the credit score. And then again, if you're motivated, the rapid rescore is an option. And then the borrowers who are below 580, like banks, they usually stop lending below 640. Brokers, some can do 620. We can do 580 with some extenuating circumstances, like maybe a little bit more money down. But we have what I think is the best credit repair company called My Credit Guy. Shout out to my man, Sam Parker. So if you're a realtor and you have a client that did not qualify because of their credit score, just go back, check your database, send them to me, and I'll work with them and My Credit Guy. And they do a great job, depending on what that borrower needs or what they have available to fix their credit. They'll get them ready to get their credit score up to 580 or 620 or whatever we need them to get to. And they'll send it right back to us so that they become an eligible borrower, which I'm sure everybody out there that's a realtor has a bunch of dead loans. So buyer strategies for new listings. We are really heading into, at least the conversations I'm having, in the fall, it was all about the buyers. It was a buyer's market. There was a lot of seller assist because there weren't a lot of people in the market to buy. They were choking on those high interest rates, and I get it. And around November, they started dropping again, that second week of November. But we still have a very low inventory of homes historically. And because the rates have dropped at least a percentage point since November, I think it's very similar to the stages of grief. People were totally at the denial and the anger stage, but now they're in the acceptance of the interest rates that are in the 6s or very low 7s. And it's becoming a seller market. I'm seeing contracts at offer price or above offer price, and it's just going to, moving forward into the spring, it's going to be more of a seller's market. So one of the things that we utilize is the appraisal waiver. Again, as a broker, we have the ability to check Fannie and Freddie at the same time and see who is going to waive the appraisal. So in this instance, the borrower, with their FICO and the loan to value is below 70, Fannie Mae said you do not have to have an appraisal done. So that is a great selling point to a seller. If you're a buyer agent, you can go to that seller, their agent, and say, hey, this property is eligible for an appraisal waiver. We can make this transaction happen quicker. It's very, very appealing to a seller. So the appraisal waiver is one way to be competitive as we move into this seller's market. And then the bid over ask. Now, as you can see in the competitive market, the asking price may not suffice. That's going to happen more and more now. I think it's going to be somewhat similar to what it was last spring, where there's contingencies waived and everybody's going to be jumping into that market again because we just have historically low inventory. So here's an example of going in with an aggressive offer. In the first column, you see the list price of $300,000. Let's assume they're putting 20% down. 240,000, and the interest rate there is like, I'm assuming someone's going to be buying in the like in the spring or summer. That's a high interest rate estimate for me. I'd much rather estimate high and come down, and there's ways that I'm able to do that I won't get into right now. But you'll see that the payment is $2,067. So in this example, I'd say, all right, well, instead of going in at offer price, go in at 320, 20,000 over list price. Borrow a little bit more money. In this example, 273,000, and buy down the rate, and also do what's called borrower paid mortgage insurance. And doing that, the interest rate goes down to 5.99. And as you can see, as I highlighted, the monthly payment is lower by, let's call it $20 than the list price appraisal. So how does that happen? I just go a little bit deeper on that. The borrow paid MI costs money. The rate buy down costs money. So you're offsetting, you're borrowing a little bit more, and you're offsetting that a little bit with buying down the interest rate and paying the MI. So what does the closing costs look like when you do it that way? About the same, about the same. So, you know, the $300,000, and obviously the numbers are different depending on the property and the taxes or whatever, but these are the kinds of things I want you as a buyer agent to be out there thinking about. It's like, hey, you don't have to explain what I'm explaining to you. You can just say, hey, I think either call me and say, hey, I think there's going to be a lot of competition. What do you think this borrower? They only have $75,000 to play with. How can we make a strong offer? And then I can go through this process with them and show them exactly how it can be done. And you know, you have, and obviously it doesn't have to be 320,000. Maybe it's 10,000. It varies, but just reach out. Let me explain it and do all the heavy lifting for the borrower. And you know, we have ourselves probably a win on the bid. Okay. Now, if we bid over asking price, how long would it take for the home to appreciate? Now, this is another thing that I offer that doesn't cost anything. It's like, okay, so, you know, if I bid, let's say I bid, someone bids in this example that I just used, if they bid 320 over the 300 asking price, I just plugged in the numbers. The asking price 300,000, bid over ask was 20,000. That, and like it, because you plugged in the zip code in Center County, Pennsylvania, it comes out to 298,338, which is right around the asking price. And I plugged in just as an example, if they bought the home in February of 2016 for $210,000. So for paying that extra $20,000, you're going to get that back owning the home in 24 months. And then there's a 5-year projection. I don't like to go out more than 5 years, but the bid over ask price, this is something that I consistently will do when someone goes in, just so they know, like even before they go in to make the bid on the house that they really like, and there's a bidding war, say, all right, what's the break even for it? I like it to be less than 36 months, which this one falls in under. And then you can go in and make that strong offer and get the house your client can get the house that they're looking for. Now, there are going to be some situations when you have a motivated seller. Maybe the house has been on the market a while. They've been transferred and they have to move in a hurry. They don't want to carry 2 mortgages, or it's a for sale by owner. There are definitely some options for that when that comes up. So this is something to keep in mind also. Again, you don't have to explain it to your clients. Just say, hey, I have a mortgage guy. He has some outside the box ideas that are been successful now. Yeah, I'm not just throwing these out there as concepts. These are things that I used last year when there was a super sellers market in the spring of 2022. And I also used it in the fall, this buyer's market strategy in the fall when the rates jumped up, but people still had to buy. People still need homes. So this is a real life situation with one of my clients. The list price was $595. their pain was closing costs. They really didn't want, they had a limit to what they wanted all to go in all in. So what I told them was, and this is also assuming that the remaining balance on the house that's up for sale is 325. Okay, so the listing price 595, interest rate, the principal and interest payment, the closing cost 57.4, and the seller nets out 234.3. So my borrower went in with a $625,000 bid. This was a bid over ask, but they asked for $15,000 seller assist, which made sure that whatever they were listing for, they were going to net out at least what they wanted to from listing price. So the listing agent and the seller are not losing anything by accepting. They weren't losing anything by accepting this deal. There's a higher loan amount, obviously the higher payment, but they ended up coming to the table with $16,000 less than they would have if they went in at offer price without the seller assist. And then the seller ended up getting a little more in net proceeds than before. So that's if someone has closing cost pain. Now, there's also buyers who will have pain with DTI, like qualifying because their debt to income's too high. They just really want the best interest rate at the time, and they want the best monthly payment. Some of those are all interrelated. Some of them are separate. But this is when I use what's called the permanent buy down strategy. There's two types. There's a permanent buy down. There's a 2-1 buy down. Just running the numbers right now, the permanent buy down is making more sense, especially with the new loan level price adjustments that are coming down the pipe. So what does that look like? And I did a side by side with the closing cost scenario too. So if that borrower had the same kind of pain or made the same offer, but they were really interested in getting a more favorable interest rate, they would go in at 624, only asked for $14,000 seller assist. This brought their interest rate down to 5.25, and their monthly payment is over $600 better than the listing price offer that they would make, and because there's mortgage insurance involved in this. And then they're coming to the table, but they're only coming to the table with like what's that, $4,800 more than they would if at the listing price offer. So this is another option. It just depends on what pain. Again, everybody has a different pain, but these are two great strategies to use. Again, and if you happen to have a motivated seller, they're not coming out of pocket. The buyer's not coming out of pocket, but the seller's not losing any money. And so the question I always get when I'm explaining this to agents is, what if the appraisal does not come in? And there is an answer to that too. It's almost similar to what I just showed you. You just offset the appraisal gap with the borrower borrowing less and using the one-time buyout of mortgage insurance. And that's almost the same thing as what I was showing you earlier with the going in with a strong offer. So here in this example, the same list price, $300,240, and the appraisal only comes in at $275, but they want to have the same loan amount and the same interest rate. They're going to have to come to the table with more money, and I'll show you that in a second. But with the appraisal gap strategy, because you're only going to be able to land off of what the house appraised for. But we keep the loan amount the same. Oops, sorry about that. Keep the loan amount the same, which keeps the payment the same. But what are we doing? You're with the appraisal gap strategy, when you have to pay the full boat, you're coming to the table with $25,000 more. If you use the appraisal gap strategy and you do the one-time buyout, you see that the closing costs, you're only bringing $2,000 more to the table, which is way better than bringing $15,000 more to the table. I'm sorry, $25,000 more to the table. If it was just like, okay, well, there was no negotiation, you have to pay the full. Like, again, that's in a seller's market. The sellers are not going to want to cover the gap, and you'd have to come to the table with $25,000 more. Here, you're only coming to the table with $2,000 more. Same payment, much better situation for you than paying that appraisal gap. All right, so that brings us to, is it still a good time to buy? I'll always say there is no bad time to buy real estate, mainly because, we are in a very low inventory market, historically low inventory market, and it's going to stay that way for a while. If you think about it, the baby boomers were the big population, and they're aging out, and the millennials are taking over. Millennials are now in their prime home buying age, in their 30s, in their mid 30s. So those inventories are going to stay low. Prices are going to still stabilize. They're not going to be appreciating at that 15-20%, but they'll be appreciating in that 6 to 10 range. So you're going to be buying a six-figure asset that's appreciating conservatively at 6% versus the couple $100 maybe that the difference in payment because the interest rates have gone up. So, your net worth is always going to outpace the high interest rate market that we're in. And I've been talking about the like all fall, because it was a buyer's market and it was the peak of interest rates. We were saying the phrase was marry the house, date the rate, divorce the rent. Now, I think temporarily you're going to have to swipe left on the rate. This loan level price adjustment, I think, is going to push back any refinance opportunities into 2024. But that's only dating the rate for about a year. And it's my job as a mortgage advisor to keep you up to date on the market monthly, quarterly, and at least one annual review where you say, all right, well, this is the interest rate. If it gets down to this is when you want to take advantage of this low interest rate market and refinance. But in the meantime, you're still gaining that equity in your home and building your net worth. So I have a YouTube channel, and all these strategies are on it. And there's a couple more that I didn't think I would have time to get into. But you can just plug in there, watch the videos. The cost of waiting is really also a good one for those people who are sitting on the side, that were sitting on those sidelines. I think a lot of people who were sitting on the sidelines in the fall, as I mentioned, they're coming to the realization that, all right, it's going to be around sixes. If it gets down to 5, fantastic. But I can't wait anymore. But I can do a cost of waiting analysis for them. Here's my contact information and all of my social media. If you want to reach out, I'm always available. I do not have a wife or life, so I'm open 24/7. That's it. Just want to make sure I don't have any questions in the chat. I do not. If you're shy and you want to reach out, or if you want me to run an analysis for a client, or if you want me to connect one of your dead loans that because of credit score, I'm more than happy to do that and have them send it right back to us when they're ready. Just reach out to me. That is it. Have a fantastic week.